Okay, hear me out. In about 6 months, a new Fed chair will be appointed. Without a doubt, a Trump puppet that will lower interest rates as much as he wants. Inflation has apparently bottomed at 3%, or anyway, it's stabilizing at 3% and not at 2%. And meanwhile, Trump is talking about stimulus checks. This is the type of behavior that will massively devalue the dollar long term and make hard assets like the S&P 500, like gold and Bitcoin, flourish. So let's put this together. First, a new Fed chair will be inevitable. Powell's term expires mid-next year, and you know exactly how this will play out. It's not some secret. Trump wants someone that will obey to him. And second of all, that will bring interest rates down. Now, second point, Trump is now there floating the idea of stimulus checks. Sure, he can call it a dividend, which is a fantastic bit of marketing. He can call it whatever he wants. But this is still money that will go to citizens and will then flow back into the economy in the forms of consumer spending, which is inflationary. So let me say that again. You've got a politically motivated Federal Reserve chair in about 6 months that will push rates down. And then you got a president pushing stimulus up, which is going to be inflationary. So you got inflation that's stubbornly stuck around 3%. So here's how the math works out. Potentially higher inflation, okay, and at the same time, lower interest rates. This is the exact recipe for currency devaluation because its real yield gets eroded by inflation. Let me just explain how this works in the simplest way I can. It's about something called the real yield. I know it sounds a little boring, but bear with me for a second because it's literally everything in this context. Think of it like this. If holding dollar pairs, let's say 3% interest rate, but the price of a cup of coffee goes up by 4%, and I'm taking a cup of coffee just to express the fact that the price of everything goes up by, let's say, 4% in the same year, that 3% doesn't mean anything because you just lost 1%. The real yield of the dollar is negative 1%. Now, normally the Federal Reserve fights this by raising interest rates, but we just established that we're about to do the exact opposite. We just know that in about 6 months, the Fed will not be able to hike rates, potentially. And that's a risk. That's a risk that the market needs to take into consideration. So they're most likely going to hold down the yield of the dollar, while inflation just keeps eating away at it. So what do? What an investor does. You trade the dollar for something that doesn't devalue. You buy hard assets, like the S&P 500, Bitcoin, but most of all, you buy gold because gold is the original hope. The government is being irresponsible. This is gold, okay? And this is a fairly big deal. The next 6 to 12 months will be extremely important for gold. Now, they have already been extremely important for gold. And this is not random. We talked about this move for a while. And I'm saying that gold is quite likely going to continue higher towards 4,900. See, macro trading is about seeing and understanding the story driving the trend. The current long-term story right now is about lower interest rates ahead, with inflation that's going to be most likely still too high to lower interest rates. But yet, the Fed will probably cut interest rates anyway. A combo that will devalue the dollar. It will erode its purchasing power and naturally make anything compared to it more expensive. Now, this is not a short-term view, don't get me wrong. This is not going to happen tomorrow. This has already been happening actually for quite a while, but this is not going to unfold in a day. It took quite a bit to go from 2,000 up to 4,000 on gold. And there's been quite a bit of consolidation actually at times and quite a bit of pullbacks. But this just gives us a long-term view of where things are most likely going to trend to. So we know that gold is most likely going to continue higher towards 4,900. And so we know that we want to be buyers along the way. Now, there will be moments, of course, where gold will pull back, like it did in early October. Pullbacks are normal things into a trend. Even the biggest market trend like this has pullbacks. And actually, to be precise, the stronger, the more impulsive a trend is, the more volatile and the more impulsive the pullbacks are. That's a matter of fact. But we simply know that we can use those pullbacks to give us entries too long. Now, obviously things can change. Now, this is the view right now, but maybe in a month, Trump will want higher interest rates. We don't know. Okay, so we have to be flexible and we have to understand, okay, this is the view right now, but then the view can change, okay? But for the time being, this is the fact that we need to keep in mind. In fact, we went long a couple of days ago in the private network because we got a technical trigger to do so. So this is how you should operate if you want to be a macro trader. You have a long-term view in mind. You know where an asset should trend to over the medium term, the long term, whatever. And then you patiently, professionally use the chart to pick your spots along the way. You don't chase. You let the entry come to you. You let the entry form. You let the setups form with simple technical analysis. This is macro trading.